which is somewhere between seed and Series A, because they have to keep going earlier and earlier to find the right type of deal flow. And so it does make it tough to find the right type of deals, I think, purely because the amount of capital that's around right now. And so I think at a later slide, we're going to cover some data points that are there around how valuations are changing over time and at different stages with the software platform that we actually invested in. So that'll be great to look at and provide some color for everyone.
Yes, for sure, for sure. Okay, so next we've got term sheet contents, just to give you guys a little bit of basic lay of the land. Obviously this is a little bit more of a targeted discussion, not the 101 talk that Laura mentioned earlier, but still want to make sure everybody's on the same page as we go through these things. So, the term sheet is sometimes known as a letter of intent or an LOI. I've also seen expression of interest or an EOI. These are all the same thing. It's, I think different sort of sub-industries and different folks maybe coming from different industries have different terms for it, but it's all the same idea, the same concept. So if you see any of those, that's all the same thing that we're talking about here. General concept is this is going to be a non-binding preliminary document. There's going to be, this is sort of the deal points that you're agreeing on and talking through before you get to the real agreements, the real long form documents that are going to control this relationship that you have with your investors. Those long forms are going to be like the purchase agreement, voting agreement, amended and restated certificate of incorporation, all those things that come along with these investments. But the term sheet stage is sort of like the courtship, right? It's, do you like me? I kind of like you. Do you want to go out and figuring that out with your investors? So I would say there's a group, NVCA, National Venture Capital Association, I think is their acronym. They have some form documents, and I'd say their form term sheet is becoming much more typically used. Again, it used to be sort of at a Series A, maybe Series seed stage that would come into play, and I'm seeing their form more and earlier and earlier these days, and so that's sort of becoming the norm. But there still is quite a bit of variation in the term sheet format and how things are presented, especially if you're at some of the earlier stages, like a SAFE or a Series seed, which we'll talk about more in a second here. And then of course there's
non-binding of it, Justin, is that it's non-binding on both ends, right? So I mean, there's a few different pieces of it that VCs might introduce, which make it difficult for you to go and quote unquote shop around the term sheet with a non-shop clause, which means that you got to decide whether or not you're going to take that venture firm's term sheet prior to rejecting and going after others to incentivize founders to, take the first term sheet that they sign. But it is the same going vice versa, which means that it's all pending the diligence, goes through. If not, it's not the venture firm's obligated to invest. And so VCs, there are certain VCs that are known to have more punitive term sheets than others. And that's something definitely to keep in mind as you get them, is looking at that so that you're not signing up for the wrong type of terms early on, or something that might just preclude you from raising from others. And that's when a good law firm like Weintraub is important to have on your team.
Yes, for sure. And sort of piggybacking on that a little bit, so there's a non-binding aspect to most of the terms, right? So like you were saying, there's maybe some punitive aspects or confidentiality that will be binding. But if you've agreed on a investment dollar amount and a share price, that's going to be non-binding until things get worked out, that due diligence is completed. But at the same time, having gone through a term sheet process and negotiation, you sort of need a good reason to deviate from what was agreed upon at the term sheet stage. Like I said, it's not like like you're breaching a contract. It's not illegal to deviate from it, but people are going to be upset with you if you don't have some legitimate reason for doing so. So it's not. So I guess the point is just to take this aspect of things seriously, and like Sabya said, it's always good to, it costs money, and I know that's a pain, especially for startups, but it's always good to get attorneys and other advisors, accountants, involved as early as possible so that you can set this up as best as possible. Because there's plenty of times where we've come in after the term sheet stage, and then we're sort of stuck with things, and the client said, "Oh, I didn't know what that meant." Like, well, sorry, but you sort of agreed to it, and we can suggest changing it, but like I said, they're going to be pissed off and yeah, not happy about it. So we sort of are stuck with what we've got here.
And on the NBCA form, that definitely is the standard. So the company that I'm going to be able to share some data from later is a company called Omni. I just dropped this. Oops, I sent it to Laura by accident. I'm dropping this in the chat so everyone can see the NBCA term sheet. It's actually enhanced with Omni data. So you can see kind of what's the median valuations, different areas that investors will usually put terms versus not. Justin was maybe just pulling it up, but you're going to be able to see that in that term sheet itself. But most typical early stage VCs will use that. So I would encourage you guys reading through that, ensuring that you understand the terms, and being able to get a good understanding of what different norms are within each of the terms across the board.
Right. And then the last thing that I was going to mention about this is there's a bit of a balance between trying to cover absolutely everything in the term sheet and then just agreeing on the key terms. So there's sort of a sliding scale there where you can have, I've seen plenty of term sheets that are just, a page or two of here's the key terms and this is what we agreed on. And then it's up to everybody else to flesh that out through the agreements. And then there's other ones where it's got, very specific language that basically gets copied and pasted from the term sheet into the long form agreements, and then everything in between. And so that's sort of a balancing act depending on the deal, depending on the investors and the company, and just sort of what makes sense for what you have going on. But yeah, the NBCA form is a great place to start and work off of. Okay, so next we've got investment types. So convertible notes, safes, convertible preferred stock, common stock, stock options, and warrants. So most of these are equity instruments. The convertible note is the one that's sort of a hybrid in that it's a traditional sort of promissory note. It's got principal and interest, but then it's got the option of converting into preferred stock at a later date. This is pretty similar to a safe, which I'm presuming most of you guys have heard of. That's a simple agreement for future equity. We work so much with these acronyms and stuff, I sometimes forget what they stand for. But so the safe concept basically simplifies a convertible note and says, you're just giving me money now, and there's no interest rate, there's no debt instrument. This is really just a cash payment for future equity. So it simplifies that process. And again, that'll typically convert with the next financing round. Part of the benefit of these, the convertible note and the safe instruments, they're used pretty early on in the financing sort of life cycle of a company. Part of the benefit of those is they sort of kick the valuation question down the road a little bit, because often these are going to be, friends and family that, want to give you money and invest in your company, but, nobody really knows what this idea or this concept, early stage company is worth. And so they kick that can down the road a little bit until someone like Sabya can come along and do some actual valuation and put some real numbers to things.
And it's completely correct. And just definitely check out the difference. I'm going to drop this link in here in terms of safes, because they have changed. There's now this, I think it's called either the Safe 2.0 or the post-money safe versus the pre-money safe. And many of you guys might know about this already, but just check out that Medium article I posted, which explains the difference, because it's 100% crucial in terms of what the actual economics mean to you as a company when the next round does come in. And everyone nowadays should be using the post-money safe, but it does have significant implications for the cap table in the next round.
Perfect, thank you. So next we've got convertible preferred stock. So this would be the stock that's issued with the Series Seed, the Alphabet Series investment rounds. So this is preferred stock because it has different rights and preferences than the common stock, something above and beyond what they have, but it has the option to convert into common stock upon some future event, hopefully an IPO or the company getting bought out or something like that. And so that's mostly going to play into the rest of the terms that we talk about here. A lot of that will have to do with preferred stock investment terms. And partially that's because the safes and the convertible notes have much less negotiable factors to them. It's a little bit more simplistic, whereas the preferred stock has a number of mechanisms that you're working with and things you're trying to negotiate and figure out.
There's a good question, actually, I can get in the chat from Tom about the post versus pre-money safe. That is correct. Justin, correct me if I'm wrong. It's only relevant if there is a valuation cap, not if there's just a discount, because usually the two different levers that exist in the safe note are going to be a discount to the next round versus a valuation cap, and I believe that's only relevant if there is a cap.
I think that's correct. Yeah.
Yeah, and just for everyone, I mean, depends on how much money everyone's raised, but in terms of how the difference is, the two different levers, you're either going to convert at the valuation cap in terms of what the next round is in terms of a pre-money valuation, or the discount to that price. So when you have a price per share in the next round, you're going to get the benefit of whichever one exists, and the new safe note is only applicable if you have a valuation cap.
Okay, so next we've got common stock, and this is sort of the baseline ownership. This is what you all as founders would have in your entities, and that's the sort of last place that all of this stuff funnels to, right? So convertible notes and safes would convert into some sort of sub preferred stock at the next round, but then that preferred stock at some future event would convert into common stock. Stock options and warrants, same sort of thing. The stock options would probably be stock options for common stock. The warrants may be for preferred, but then again, it all cycles back to common stock at some point down the road. So that's a fairly easy concept for us to deal with here. Stock options and warrants, from my perspective, those are sort of the same legal concept, but the way those terms are used in this sort of environment is generally that stock options are something that's generally considered available as a pool of shares for employees, maybe vendors that you're working with, and so that's sort of a pool of stock that sits there and is available to incentivize folks that are working with you, basically, either to align them with the interests of the company or to give them a little bit of a kicker because you're a startup and you can't really pay them that much money yet. So that's sort of the stock option terminology. And then a warrant is really the same thing. It's a contractual right to purchase stock of the company, but warrants, that term is generally used more, at least from what I've seen, for a benefit for the investors as opposed to the employees or the vendors. And what we see there is generally, again, this contractual right to purchase more stock, but it would be the right to purchase more preferred shares. And it's sort of used as a sweetener or a fallback in certain deals. So we're actually doing a financing round right now where we represent the company, and the company and the investor can't quite agree on the valuation of the company. I don't remember the numbers exactly, but they're a couple million off. And so what we've arranged is that if the company doesn't hit certain revenue metrics, in a year, basically, then the investor has the right to purchase additional Series A shares for basically no money. So the concept is we'll value you at your valuation now, but if you don't hit the targets that you think you're going to hit, we get to basically go back and value you at our valuation. And so it's a good way to get the deal done, but keep everybody happy, right? Because if the investor, if the company hits their targets, then everybody's happy because they're doing well. And if they don't, then the company's protected and it got its original valuation. So that's how we see that used. Anything more on that, Sabya?
No, I think you covered everything. There is a lot that's going on right now from a regulatory standpoint as it applies to stock options, taxes, etc. So do make sure to keep an eye out for that. If you, I think, follow the NBCA newsletter, you'll see a lot about that. That's going to have significant impacts for your employees in terms of exercising taxes, etc. So do check on that from a stock option standpoint. Again, it's a tax and legal thing, but there's a lot changing there. The other thing is that the idea is to minimize the exercise price for your employees. However, that may apply when it comes to doing your evaluations that will determine the exercise price. Another important thing to consult counsel about, but does make a massive impact down the road as you all think about it. But no, I think you covered everything, Justin. And from a warrant standpoint, rarely will I see that used outside of advisors or investors, but usually you will only see that in some type of investor agreement.
Right. Okay. And shame on me for letting Sabya warn you guys about upcoming legislation and the legal risks with this stuff. That's my bad.
Looking for my honorary JD.
Yeah. All right. So next we've got valuation. We've talked a little bit about pre-money and post-money already. The calculation is not necessarily my. I guess none of the valuation part is really my particular area, but there's a number of helpful online startup calculators that you can sort of plug this stuff in, so you can figure out what the heck people are talking about if you're not mathematically inclined, like I'm not. But basically, the way I think about it is pretty simple calculation where post-money valuation equals the current value plus whatever investment is coming on board. Hopefully, I've said that correctly. But obviously, the sort of variable in there is how you get to that current valuation and what the investment's going to be. So I'll sort of hand it over to Sabya in terms of what metrics and methods you guys look at when you're valuing a company.
Yeah, and people like to say that evaluation is more art than science, which pretty much means that it's very arbitrary and there may not be a rhyme or reason. It's very much dependent on stage, sector, so on and so forth, and it's tough to try and figure out a very basic formula. As your company grows beyond, I'd say that the Series A stage or whatever might be significant revenue in the eyes of the investor, it's easier to peg a valuation based on some market comps or multiples. But until you get to that point, it's kind of a beauty in the eyes of the beholder type of situation. What I would say is there is a formula out there once you cross maybe the $1 million ARR mark, which pretty much says, let's take your current annual recurring revenue or your next 12 months projection, multiply it by some constant, multiplied by your growth rate. I forget which firm coined that, but that does exist out there. And that's kind of a rule of thumb that we use, at least in terms of just, getting us to have a good gut check. And so just to repeat that, your current ARR multiplied by some constant times your annual growth rate. So if you're doing $1 million a year and your growth rate is 100%, we pick a constant. For us, it's 5. You'd be valued somewhere between $5 and $6 million pre-money. That's a rule of thumb. But until you get to that point, it's really difficult to calculate growth rates. Growing from 100,000 in annual revenue to 500 sounds really great from a percentage standpoint, but doesn't mean much in terms of absolute dollars sometimes. So what I can do is I'm going to share my screen and be able to show some benchmark data from the company I mentioned earlier, Omni, that does serve as VC firms to help them manage their portfolios. So if we could pause the recording here, Jeff.
I think we have a post-presentation question time specifically, but yeah, if you guys have questions throughout, we can always answer them as we're going along. Either way works. Okay. All right, so I will continue on here. Is my screen's back up?
Yep.
Yes.
Okay. All right, so we're getting into a little more technical terminology here. So we've got liquidation rights preferences. We got non-participating preferred stock, participating, and then a cap on preferred stock participation. So general concept here is on a liquidation of the company, what is the preferred stock going to do? And so liquidation is when the company is selling off all its assets. So a non-participating preferred stock basically means in general, the preferred stock is going to get a return of its capital or perhaps a multiple of its capital sort of prior to anything else going to the common shareholders. Participating preferred is you have that same return of capital or multiple, and then they get to also convert into common stock and participate at that next level. So that's obviously a great benefit for the investor in that scenario because they sort of double dip in that scenario. And then the cap is sort of a bit of a middle ground, a hybrid, where the investor again gets both of those options, but there's a cap on how much they participate in the common stock level of things. So it's a 50% participation at that level or something like that. I'm actually just making that number up because I haven't really seen that too much, the cap version of it. Maybe 50% is not a good number, but it's fine enough for the concept here. What sort of stuff have you seen typically, Sabya, or what do you guys typically offer?
Yeah, and so I would say non-participating preferred stock is the norm for early stage venture. If you're going to get a participating preferred, term sheet is usually going to be non-standard at the pre-seed and seed stages. On the cap side of things, so just to clarify how the math would work for that is, like, participating preferred stock is pretty much when the company exits, you're going to get your investment plus your percentage ownership of the remaining amount. So you get a double dip. The cap pretty much means once you cross 3 times or 4 times or whatever it is, your invested amount, your participating aspect of it stops. So that's usually more common on later stage deals. And so we wouldn't look at a cap earlier than, let's say, a Series B. So non-participating is what you would usually see across the board at the seed and Series A stage.
Perfect. All right. So next we have voting rights. So the basic concept here is this allows preferred shareholders to elect a certain number of directors on the board. So I wanted to take a moment here and sort of break down some of these things here, some of the different roles that folks are going to take. So a shareholder, is an owner of the company in some form or fashion, whether a common stockholder or a preferred shareholder. For the most part, the shareholder job is to, vote on the directors and maybe has some approval over certain big ticket items. And then the directors generally oversee sort of a 10,000-foot view of the company, and then their vision is carried out by the officers, sort of the day-to-day operators. So part of what this these voting rights in this setup gets to is it allows the preferred shareholders to have sort of an outsized control over the board, right? So they may be able to select a majority of the board, or at least appoint one board member when they may not be able to do that, depending on the relative number of shares and all of that. So it's sort of independent of what the numbers shake out to. We don't care what that math looks like. We want sort of a contractual right to be able to appoint our own directors, and that obviously gives them a bigger stake and a bigger control portion of the board.
And that is a really important thing to think about as you see term sheets and investment agreements, because a lot of times people pretty much say we can do any number of things and you contractually agree to it, which is from replacing founders to there's a lot of things that are going to be there that each class of share, if you're going to raise a Series A, the Series A director, who is appointed by usually the majority or the lead of that Series A, can do. that is really important to look into. And there's great examples of why that's become a bad thing when things go south. So I think the net of it is investors can pretty much put anything down on a term sheet. And to be fully candid, right, it's something that everyone should look out for, because you want to be protected as a founder, that they don't get any type of punitive rights, which is really important.
And so the other thing that's sort of wrapped up into this is, so you've got that ability to elect board members. This similar provisions would also set the number of directors, so that if they want to have control of the board, and they're allowed to appoint 3 directors. They want to set the board at 5 directors so that they can maintain that majority. Otherwise, you just add more directors and you sort of pack the board, and all of a sudden they don't have the control that they wanted before. And again, sort of related to this, there's potentially some shareholder approvals that they may work in there, and we'll sort of talk about it in the protective provisions section in the next slide or two. But that would be something that either you can define it a couple of ways: either the preferred shareholders as a group, or maybe just the sort of lead investor gets to approve these things. Again, it's sort of contractual and depends on some of the deal dynamics, but those are other ways that they can sort of exert control that you wouldn't normally be able to, given the numbers and everything else. The last thing that I wanted to mention here was there may also be sort of a board observer right. So besides appointing actual directors to the board who vote and have fiduciary responsibilities and help like run the company, oftentimes there's an observer who's appointed as well. Do you guys do that, Sabya? You often have a board observer as well as a director, or?
Yeah. And I'm actually on a couple of boards as an observer, and something for y'all to keep in mind in terms of VCs that don't want a board seat but do want to be an observer is that that's the same number of voices in the room. And so a lot of times the board observer, even though they don't have a contractual right to vote on things, can turn the tide in terms of the conversation, because everyone's still speaking. And so just something to keep in mind is that it's not a very minor thing to have a board observer join. It still does have some significant impact. Right. But yeah, we do that quite often. And one thing that Laura mentioned, right, getting attorneys to review it for you, not doing that correctly early on can have significant issues down the road. We've had a lot of cases where there's been hundreds of thousands of dollars spent on fixing legal agreements, fixing issues that have applied to to the company, how it's been ran for the past 2 years, because they didn't have the right law firm doing that for them. So ensuring that happens early on. This is not a pitch for Weintraub, don't worry. I don't think I'm allowed to do that, Justin. But pretty much ensuring that's done properly early on can save a lot of money down the road and headaches. But yeah.
Oh, for sure. I mean, we've done a number of deals where we come on when a company is getting some significant financing, and oftentimes the first thing that we do is go through their LegalZoom documents and correct things and help them with some of the stuff that they missed and get it ready to actually take on this investment before other people look at it. Sort of get it cleaned in house on our end. And yeah, so you're paying for that twice instead of just doing it at the beginning. But I did want to mention one board observer situation that I've seen. We had a Chinese investment company invest in a California-based startup, and so they had a Chinese national as the director, and then they had a San Francisco-based person as the observer. So didn't talk with them explicitly, but the concept there, at least to me, seemed like they wanted somebody a little bit closer to the company to be involved. The San Francisco guy spoke better English. Not that Chinese guy didn't speak much better English than my Mandarin is, but so I think it was good for them to have somebody a little bit more local to the company. So I think that's often helpful too if there's some international component to things. Okay, yeah, so to sort of continue that a little bit, these protective provisions here. So basically we've got a couple of items, a couple of events, activities that a company would do, if they're trying to liquidate or dissolve, if they want to change the articles or the bylaws, issue new security, create a subsidiary or a parent or affiliate, or change the number of directors like we talked about before. They generally require a threshold amount of the preferred shares. Well, a couple of things. They could have the preferred shares voting on this. They could have the board of directors has to approve these things. And then sort of leading into the next one, they could maybe have just a certain number of directors or certain directors in particular approve these things. And so again, this is a way for them to protect themselves and sort of exert its outsized control, given the not sure what happened there, but I see Sabya has entered the waiting room. So
I think I just let him in. I think he must have had, he mentioned poor internet, so he must have had an issue.
So this again is a way for them to exercise outsized control, given the number of shares or the number of board seats that they have. But obviously these folks are the ones writing the big checks. So it's, numbers wise, it's outsized, but it's not unjustified. And this gives them that sort of preferred shareholder status and this additional contractual rights that they bargained for. One thing that I'll note here is generally it does require that there's at least some or maybe a threshold amount of preferred shares outstanding. So if people either a number of shares or maybe a percentage. So if you've got a series of rounds and these preferred shares are diluted, or if your initial investor sells off some of their shares to somebody else, and drops below some threshold that you've established, at a certain point, right, it doesn't make sense for them to have the same outsized control that they had before when they were such a big part of the company. If they're down to, I'm literally holding one more share, okay, maybe they shouldn't be able to approve or to veto all of these things that are so fundamental to the company because you're no longer involved in the same way that you were before. And so, yeah, so that leads into to the veto rights. And so this is, it's again, sort of terminology. Some of the stuff is probably a little bit similar to the term sheet LOI terminology, where some of it's interchangeable. But this concept is really where you have a specific director has to approve things. So even if the investor only appoints one director, and there's five total board members, they couldn't by themselves control the board. They could get outvoted on everything. If you got these veto rights and this sort of additional protective provision, again, gives them that control. You basically say, hey, any of these big ticket items that the company is trying to accomplish, I have to be part of the group that's approving that. Otherwise, I basically get to veto it, even if it's 4-1, and I would normally lose. We've bargained for this deal here, and so I need to be part of the approval process.
And some things here that are important, I think, for us, right? This has actually, been an issue in the past, which is why we instituted it, which is if we invest prior to the next round, any change in founder salary would require approval from us as the board director, because, let's say you raise $2 million and the company's not doing well, you change your own salary to $700,000 a year, it becomes a huge issue for us, right? So there are certain things that investors do that are help the company and all shareholders, but just something to keep in mind that is stuff that can be instituted. The other thing that's not a direct veto, but stuff that requires shareholder approval is if we have the majority of the voting class of shares or something, we would have, de facto, is that the right word? Just de facto block rights. I don't know my Latin well enough, but be able to have block rights where we can, still vote to veto something, even though we don't have actually it's not de facto, it's the opposite. But we can still vote against that just purely because we own the majority of the voting class of shares. So that is something that investors would have. So as you kind of build your cap table going forward, there might be investors that have just block rights purely based on the amount of shares that they own in the company. So something else to keep in mind as you bring on investors.
Yeah. You're talking about the sort of concept where you've got voting on certain matters by each class. So like, so 50% of the or more of the common shareholders have to approve something, and majority of Class A, Series C, all that sort of stuff. And so, like he's saying, even if you only have a majority of your block, if it has to sort of get past each of those thresholds, then you still like have to. I don't know. You said de facto. Now it's all I can think of. So I was going to say de facto veto right, but
it's why I didn't go to law school. But pretty much, So I mean, there are certain things that you would have a block right just by owning a certain class of share that they could veto against. But no, you're right. There is a backstop as long as they don't own the majority of each class, for example. Yep.
Right. And Sabya mentioned. Founder compensation. Some of the other things that I've seen pretty commonly are, the company taking out loans, guaranteeing loans, interested transactions. So that would be, if the founder has another company that provides services to the startup, that's, he's sort of sitting on two sides of the table there. So that's something that would probably need to be approved. Some equity arrangements, and sometimes you just have a threshold for a contract amount, where you don't want the company entering into sort of too big a contract without people looking at it. And so there's usually a dollar threshold that would be associated with that. Okay. So next we've got anti-dilution. So again, sort of similar to the liquidation, we've got these three different versions: broad-based weighted average, narrow-based weighted average, and then full ratchet. So these are basically to protect the investor in a down round dilution situation. So the broad-based weighted average takes the total number of outstanding preferred shares plus the common stock reserved for issuance. So if there's something that's authorized but not outstanding, then that's included. The narrow-based basically drops that off and just takes the total number of outstanding preferred shares when it's making this calculation. And then full ratchet is basically when you have that down round, you would change the conversion price of the preferred stock to whatever that down round price is. So I think I skipped over that a little bit. So let me back up. On the weighted average scenarios, basically what you're doing is you're taking the price of shares sort of across the board, including the prior rounds and then this down round, and you're changing the preferred stock's conversion rate based on that weighted average. And so if you have if the stock was $5 when the company invested, and now the down round is $2.50, you're going to take a weighted average of all the shares, and they're going to end up somewhere in the middle. Okay, now I can convert at $3 or something like that. And with the full ratchet, what you're saying is, you skip over all of that averaging, and you just say, I was $5, now I can convert at $2.50. And the mathematical result of that is basically that, their money's going further. They're getting more shares relative to, well, not relative to everybody else, but they're sort of maintaining their percentage of shares that they would have gotten based on their original economics.
And at a seed or Series A stage, if you ever see a full ratchet term sheet, and this is a fun story for me too, because the very first term sheet that I issued had a full ratchet provision, and it was rejected within maybe like 30 minutes. If you ever see that type of term, run at an early stage, because no one should be giving full ratchet provisions at a seed stage investment, because pretty much it means they would be never getting diluted. If you have a down round, they're going to be able to get the best price across the board. You would see that in probably growth stage rounds, but broad-based weighted average is pretty much, I think, the norm, probably what you've seen, Justin, as well, across the board, from usual seed Series A term sheets.
Yes, yeah, for sure. Okay, so next we've got right of first refusal.
There was a question just on the anti-dilution. Is anti-dilution contingent on participation in the round? Do you want to take that?
Sure. So yeah, the way I'm interpreting the question, at least, is that participation and anti-dilution are sort of separate things. We talk about, I think we talk about right to participate in future rounds in a further slide. I mean, they sort of, there's sort of different levers that you can work with here and push on one thing and pull on the other, but I wouldn't say they're contingent on each other.
And Tom, I think, were you asking if the anti-dilution is contingent on participating in a future round, or just generally? Because if it's the prior, I'm assuming that you mean that participating in the next round would guarantee your anti-dilution preference, which is not the case. It's just purely based on the class of share that you have invested in the first place.
Yeah, okay. So I see Jeff is sort of commenting on the timing here. Since we're taking questions sort of throughout, I figured we wouldn't have.
Sorry about that. I entered that in the wrong chat box. That was actually meant for Laura. My apologies. Yeah, we're a little over on the presentation, so it might be good to kind of start wrapping that up, and so we can get to some Q&A. We can, if you guys are able to, we can go over a little bit, but let's kind of maybe think about wrapping that up a bit.
Sure. Yeah, I figured we wouldn't have too much of a problem since we're getting through some of the questions now. But yeah, certainly try and speed it up. This will be the first time that I've talked too long. Okay, so right of first refusal is basically the right of the company. Usually it's the company first and then other investors to purchase shares instead of a third party. So basically, if Sabya and I have a company and I say, I don't want to work with you anymore, I want to sell my shares, I'm going to sell them to Jeff. Jeff's going to give me $500,000. First, the company has the right to say, we're going to pay $500,000, and they'd be able to take them, and Jeff would be out of luck. And then if the company doesn't, then Sabya would have the right to say, okay, I'll pay $500,000. And part of the reason for this is sort of a balance between the ability of somebody to sell their shares and have some liquidity, but also not force the company or the other investors to get involved with somebody, some random third party that they may or may not want to do business with. So it gives them that ability to sort of keep those people out. But of course, they do have to come out of pocket to pay for it. Tag along rights is basically, so continuing that scenario, if I say to—
Hey, Justin, I'm not sure if you're forwarding your slides, but it's still on anti-dilution on my end.
Yeah, there we go. Sorry about that. So tag along, sort of continuing that example, is if I say I'm going to sell 1 million of my shares to Jeff, and Sabya is 50% shareholder with me, and he's got 1 million as well. He can say, all right, the investor group is going to sell $1 million to Jeff, so he gets what he bargained for, but I'm going to participate in that. And he gets to say, I'm going to sell 500,000 shares, and you can sell 500,000 shares, but you don't have the unilateral right to get out of this company. I get to participate and sort of tag along with your deal. And that's sort of so you prevent people from fleeing the sinking ship, and sort of the first one to pull the trigger gets out. Yeah, so everybody can participate and maybe get some equity and get some money out of the deal. And then drag along is basically the opposite of that. It's the right to force other shareholders to participate in the sale. So if Jeff says, hey, I'm interested in buying the shares of the company, but I don't want to be a 50% owner, I need to have the whole thing. If I have usually a majority or maybe a super majority of the shares voting with me, then we can vote to force the minority to sell their shares as well. And basically say, enough of us have decided to sell the company, and the fact that you don't want to, we've got this contractual right, and so it doesn't matter, and everybody has to sell to Jeff. So congrats, Jeff, on that windfall.
Yay! Thank you.
Anything else on that, Sabya? Sorry. Okay. Okay, so a couple of things that relate to founders. So like we talked about, the founders are going to have common stock, and that may already be subject to buyback or a vesting schedule. You know, the general vesting schedule that I've seen is something like a 4-year vest, maybe with a 1-year cliff. And some folks implement that at the formation of the company. Some don't. And then when you have the investor round, the investors may insist on sort of a new schedule. They may say, okay, you didn't have one before, and so we want to implement one now. Or they may say you had a short schedule, a short vesting period, and so we want to extend that, and we want to change that. And part of the reason for that, you know, Sabya can comment a little bit more, but part of the reason for that is, you know, they're, especially for a very early stage company, they're investing in the founders, right? It's not just the product or the service, because that may or may not even exist yet. And so they want to ensure that the founder is properly incentivized, that they're going to stick around, you know, that they're not just going to sort of piggyback off of this money and then walk away with a windfall, essentially, and leave it to other people to run. You want to keep them involved. So similarly, there may be some non-competition agreements, which is sort of self-explanatory. You know, the founder can't compete with the company after they leave. Some, you know, generally not in California, but other jurisdictions, they may have some similar non-competes for employees that they try to implement. In California, a non-compete agreement has to be tied to the sale of the ownership of the company. So if you are like fired as an employee, that sort of in and of itself doesn't count as something fundamental enough to implement non-competition provisions. It has to be with the ownership of the company. So if the employee doesn't have shares, then they're free to go basically wherever they want, and the non-compete's unenforceable in California. But for the founders, as long as it's set up the right way, again, sort of tied to that ownership, then they can sort of be bound and required not to compete with the company, again, with certain parameters.
And hey, Justin, sorry, I got cut out for a minute if there was any questions that you had asked in the middle. But if we just go back for a sec, the founder piece of it, the founder vesting in terms of shares, right? There's either going to be, did you already cover reverse vesting or founder vesting or no?
Sort of breezing through it.
Okay, got it. But yeah, pretty much if you're going to be issued new shares, you'll be issued new shares like any other employee. If not, you're taking your entire ownership, some percentage of it, and being reissued that over time. So I'm assuming you covered that. There was a question in the chat, I think. And I would encourage everyone to just put some questions in the chat. I know we only have like 5-6 minutes left, about pre-seed best to use a safe rather than the priced equity round. Most likely, almost all the time, if you're raising less than, you know, $200,000-$300,000, I would recommend using a safe, instead of doing a price round. It's quite expensive to draft an entire set of documents for a price round, and usually unnecessary. And now with the new post-money safes, what that means is pretty much someone that's investing X dollars knows what percentage that they're going to get in a company before they invest. So I would recommend doing that early on. We don't do safes because it doesn't give you a lot of the protected provisions and rights that Justin's mentioned earlier. So your typical, you know, seed, late seed, or Series A investors are always going to want a priced round, but starting with a safe is usually the right move.
Yeah. All right, just a couple more slides here, and we'll wrap this up. So often people are negotiating for management and information rights. This is, you know, reasonable access to the company, facilities, and personnel, financial statements, maybe an operating budget. This can potentially be limited to specific investors, not necessarily the whole preferred shareholder group. But this gives investors access they may not otherwise have. But you know, if you've got a director and an observer, you know, you may or may not need these additional management information rights because you've got that access through other mechanisms. But if you're not somebody that's appointing one of those directors, then this may be something you're looking for because you don't necessarily have that direct access like a Moneta would or something. So this is the participation rights. Basically, it's, as it sounds, the right to participate in subsequent issuances of equity. The concept here is basically, usually it's a right to maintain your pro rata percentage ownership. So if the investors have 10%, they have the right to participate in the next round to maintain their 10% and to not get diluted just from the additional shares coming on. This is a good right to protect the investors and help them maintain and sort of keep investing in the company, but it does require that they come out of pocket. So it's not free shares that get issued to them. It's they are investing sort of along with the next round of folks. So they're paying for these shares. So that's a different concept than like the warrants that we talked about, where technically they may be paying less than a penny for each share, and some money's coming out of pocket, but nothing significant. This is a real participation and out-of-pocket expense. And generally that'll trickle down. If there's a number of shareholders who have that right and some don't participate, then the others who are participating sort of get an increased share and can participate a little bit more. Okay, so some other what I've called administrative terms, just sort of a number of other things that didn't merit their own slide. So expenses. Oftentimes the company is required to pay for at least the lead investor's expenses, including attorney's fees. That gets wrapped up a little bit just in the money coming in, right? If you're getting a couple $1 million and you're also paying for their attorney's fees, it matters a little less because they're sort of just carving off a piece of that check to go back to their to their service providers. And I'd say traditionally, at least, that's pretty common. Sabya, have you seen any, I don't know, maybe do you guys do this regularly, and have you seen any pushback on this recently with just more competition and the changing environment?
On the expenses side? Or?
Mm-hmm.
Yeah, so we typically would still see, at least at the Series A stage, 10 to 15, if not 20, and not much pushback.
Okay. So this gets to the no shop and confidentiality that Sabya mentioned earlier, right? So this is where you can't solicit or negotiate other offers when you've signed this term sheet. You can't disclose the terms of the term sheet. There may or may not be an NDA, a non-disclosure agreement, sometimes called a confidentiality agreement, that's in place before the term sheet that would also have similar confidentiality provisions, but prevents you from sort of playing the investors against one another. CFIUS is the Committee on Foreign Investment in the United States. So sometimes if there's foreign investors involved with a round and the company has what's called critical technologies, there's a couple of other triggers. You might have to submit the investment transaction to CFIUS and get it approved. This is basically to prevent foreign governments from stealing or taking advantage of American technology. So that's something, if you're getting foreign investment, that you may need to look at. And then sort of just wrapping up some of the other vesting concepts. So the investing of employee options would typically be covered as well. And again, something like a 4-year vest with a 1-year cliff seems to be pretty typical. And again, this just sort of incentivizes people to stay at the company, aligns their interests a little bit more with the company because it's, how they do directly affects their stock price and whether or not these options are going to be worth any money, sort of above and beyond a paycheck or a salary that they're getting. Oh, so I didn't add Sabya's picture to the last one. I added it to the beginning, but I forgot it here.
Well, we haven't seen him anyway, so I think it's appropriate.
We can go back to our slide and show a picture.
I'll say hello to everyone here. I'm on my phone because of the lack of internet issues here. So.
Okay. So yeah, I don't know. We weren't too bad there. We sped through the end a little bit, obviously. So I was just gonna. Well, I don't know. Laura and Jeff, you can comment a little bit here, but I thought we'd maybe try and take a couple minutes for the folks that can stick around.
Yeah. Actually, we can stay until 6:45 if that works for you. Sabya said he could stay late so that people get to ask their questions. And we do have a few questions in the chat. So I'm going to go ahead and ask the folks who put them in the chat, they want to unmute themselves and ask their question. Jim, I think you had the first one that we hadn't answered yet. Jim Moon.
Yeah, one of the questions I asked was regarding stock option pools. Often the investor wants the stock option pool to be increased to the equivalent of 15% of the post-deal shares outstanding on a fully diluted basis, but they want those shares allocated to the pool as part of the pre-money value. And I've always countered that by saying, I'll put my 15% in pre-money, 15% of the pre-money shares are in the option pool, but post-money, to expand it, we all contribute to that. So the investors contribute to that option pool from a dilution point of view, as well as the founders or the current shareholders. Any thoughts on that piece? Because that can be a significant piece of dilution to the original founders of the company if they have to contribute those full shares as part of the pre-money value. That's really kind of a question for Moneta about.
Great question.
Yeah.
And so typically we would say 10 is our number, and that's based on a post-money valuation. Mm-hmm. So.
But do the shares come in post-money or pre-money?
Usually pre. We've negotiated many that come in post. Other way around. Mostly it's post, right? So it's 10% post-money pool of the entire round. So you're right in that the founder bears most of the dilution or existing stockholders. But again, this goes back to negotiating good term sheets that are more quote unquote founder friendly. You can definitely negotiate it the other way. Sometimes we'll split the difference. And again, this is me just being brutally honest in terms of, in our mind, right, we want to own X percentage of a company after the fact. That's our usual investment thesis. So we would usually negotiate it that way. But I would encourage you to look at it the other way. I think there are averages at each stage in terms of how much of a pool you need. 10 usually being the minimum number. Sometimes would go up to 15 or even 20 sometimes, depending on where you're at, what your cap table looks like. But I would encourage a 10% post-money pool to be what you look at generally. I don't know, Justin, do you see different?
No, I mean, that's, obviously that gets to some valuation and dilution in business terms that, sometimes we're involved with. Sometimes it's, preordained and we're a little bit more scribes. But I think those numbers bear out from what I've seen.
Okay. I would be thinking terms typically more of 15%, but that's perhaps more in the high-tech arena because options are key to being able to attract the kind of employees you need, particularly given the Silicon Valley compensation plans that you're competing with. Equity is a significant part of the attraction to being able to get key employees on board. So,
yeah, and I would remember that, right? Like, it's not that you can only increase the option pool at each funding round. You can have
you can do it in between, but that's something that needs to be considered also in a term sheet, particularly since the preferreds are going to have both all their anti-dilution provisions, but also their veto right, their veto provisions. I think it's important to negotiate that size of the option pool as part of the term sheet negotiation, and when those shares get added, whether they're all come out of the founders dilution or everybody shares in that. So
no, you're 100% right, and that does come in as part of that initial discussion.
Yeah.
Yep.
Let's get to the next question. Dave has a question.
Right, hi. Yeah, so thanks for the talk, Justin and Sabya. This question is for Sabya. So if Moneta leads the Series A round, at what point does it start talking to the follower investors after they've agreed? That's my first question. The second question is, it seems to me that every investor is going to be out for their own interests. So should it be expected a lot of tension, that to have Moneta lead and it, I guess, sets certain terms?
So sorry, I didn't understand that. Can you say the first part again?
Oh, so if Moneta leads Series A, I guess at what point does it start talking to the follower investors of Series A, right? If you're the lead investor.
Following meaning the next round, right? Not the other investors that same round.
Or people investing the same round, right? If they want to invest in the same round, but we want Moneta to lead that.
Yeah, so I mean, it depends on who's bringing them in. If we're bringing them in ourselves, we would be obviously talking to them right away. If you're bringing them in, I mean, as soon as they're interested, we would start talking to them. So it's pretty much right away. That's usually not an issue. It's usually at your discretion.
Okay. And I guess, is there in that situation, should there be expected a certain degree of, I guess, how much transparency to reduce, I guess, competition or tension between these various investors who are trying to give themselves the best deal?
As in, like, leading a new round.
Yeah, or following your round, I guess.
Yeah, and following our round usually not an issue, right? In terms of we'll be on the same side of the table at that point. For the exact same round, it becomes, sometimes contentious, and that's the best type of round for you as a founder, is when people are either one competing for it or trying to preempt the next round. But for the future round, it's less of an issue in terms of contention between a fund that led the previous one and the next one, because the founder and the investor are on the same side of the table. So we'll be doing reference calls and everything else, and usually that's not an issue at all. It's always been positive as long as it's not a down round, right? When it becomes a negative situation, then it becomes an oddly contentious issue because we are now sitting on opposite sides of the table.
I see. Thank you.
Yeah.
Okay. Anybody else have questions?
One other question for Moneta. Do you have any considerations or concerns about the number of shareholders in a deal, or in the deal, and particularly smaller shareholders, perhaps, who have contributed funding into the startup of the company, and how many of those people are out there? What are your thoughts on that?
Yeah, usually it's not an issue with the number of shareholders. It has to do with who
they are. Yeah.
Well, yeah, one is who they are, but who the key managers are and how they're compensated share-wise, right? So if the CEO doesn't have enough stock in a company, it becomes an issue for us. That type of thing. But the cap table, we've seen a lot of funky cap tables, and many later stage funds will recap when they invest. At an early stage, you want to keep it as simple as possible. So we say just, don't keep any quote unquote dead weight on the cap table, which is, folks that have left the company a long time ago that own 40%, that becomes an issue.
Right.
Yeah.
Okay. Do we have any other questions out there? If you could just quickly unmute yourself if you've got one that you're dying to ask. Whoops. And I'm taking a poll too, if you want to. I think everyone. Oh, it looks like we've got some very deal interested folks here. No surprise, since you came to a term sheet workshop. So Jeff and I will consider the topics that you have there. Well, if there aren't any more questions, we've got a few things to wrap up with. So I'll say going once, going twice, 3 times. All right. Well, thank you so much, Justin and Sabya. It's really been enlightening. And oh my gosh, there's a lot to learn about term sheets. So I highly recommend that people consult with their attorney when they're putting a deal together.